Hi everyone, welcome to this segment of our Week 3 live chat for Finance 4443, Financial Policy and Strategy. Of course, I'm Dr. Mark Dennis, your guide through today's session. Remember, you can always reach out to me at the email or phone number listed here anytime you have questions or maybe need a little extra help. And for this segment, we're diving into one of the most important concepts in corporate finance, the cost of capital. Chapter 11 is foundational because it helps us understand what it really costs for a firm to raise capital and how that affects the company's decisions about investing in various types of projects. You'll also see how these costs are not set by the company itself. Instead, they are heavily influenced by the marketplace and especially by the expectations of investors. If you are looking for a bit more help visualizing how all of this works, and by this I mean the weighted average cost of capital, I recommend checking out the video linked here on that topic. It's a short but helpful explanation of what we're going to be discussing in more detail here. And of course, when you download this slide deck from the course announcements, you can access the video link there. Or if you like, feel free to browse YouTube for other tutorials on the topic of weighted average cost of capital. So what is the cost of capital? It's essentially the firm's average cost of funds, the return that investors require in order to put their money into the firm. Think of it as a benchmark. A company must earn at least this much on its investments just to cover the cost of financing them. In other words, it's the minimum return required to keep investors happy and to fund future growth. Now here's something critical. The firm does not get to decide what its capital costs. It is the investors, the people, and the institutions in the financial markets who set the bar. And the firm's cost of capital will fluctuate as conditions in the market change. They will also fluctuate with shifts in the risk tolerance level of investors, as well as when the firm's perceived risk goes up or down. So market sentiment matters. In fact, it matters quite a bit. Let's go over two key definitions. First, WACC, the weighted average cost of capital. It's the overall required return based on all sources of capital: debt, preferred stock, and equity. Second, capital structure. This refers to how a firm finances its operations, typically through some mix of debt and equity. Every decision a firm makes about how to raise money affects the weighted average cost of capital for that firm. Cost of debt. When we talk about the cost of debt, we mean the rate the company must pay in order to borrow money. But here's the twist. Interest on corporate debt is tax deductible, so the true cost to the firm is actually less than the nominal interest rate. That's why we adjust it using the formula shown here. R sub dt is equal to R sub d times 1 minus t, where capital T is the tax rate and R sub d is the yield to maturity of the bond financing. Cost of equity. Equity is a bit more complex. The cost of equity reflects what stockholders expect to earn on their investment. This includes dividends to preferred shareholders, returns to common shareholders from reinvested profits, and the cost of issuing new shares, which involves flotation costs. In short, equity is not free, and depending on how the firm raises it, the cost can vary quite a bit. Target capital structure. The optimal capital structure is a magic mix of debt, preferred stock, and equity which will maximize the firm's stock price. It's not just about lowering the weighted average cost of capital. It's about strategically choosing the right balance that keeps investors confident and the business well capitalized. Weighted average cost of capital, WACC, or simply WACC. WACC brings it all together. Rather than analyze debt, equity, and preferred stock separately, we combine them into a single rate, a blended required rate of return. Each component is weighted based on how much of the firm's capital it represents. Let's briefly step through the basic formula for calculating weighted average cost of capital. WACC is equal to the weight of the debt financing, W sub D, multiplied by the expected return on the debt financing, R sub DT, after adjusting for taxes. We add to that the weight of the preferred stock financing, multiplied by the expected return on preferred stock, R sub PS. And then finally we add the third component, the equity financing component, the common stock. This is the weight of the common stock financing, W sub S, multiplied by the expected return on the equity financing, R sub S. These weights are usually based on the firm's market value, not its book value, for more accurate decision making. Spend some time reviewing this formula. It is used extensively in the world of business finance. It is one of the few formulas you should probably memorize. Let's explore the logic behind weighted average cost of capital. Here's why we use WACC rather than just looking at the financing for one specific project. Whether a corporate project is financed with debt, with equity, or with both, it ultimately affects the entire firm's capital structure. So to be consistent and fair, we evaluate all new investments using the company's average cost of capital, not just the cost of the funds that might be applied to that one project. Let's compare the firm's cost of capital versus required rates of return expected by investors, and in particular with regard to debt. From the investor's side, R sub D equals the yield to maturity, which represents the return they demand from their investments in the firm's debt. These would be the bond investors. From the firm's side, that's the before tax cost of debt. But because there is an interest tax shield for the corporation, which means the corporation is allowed to take a tax deduction for interest payments made on debt funding, the true cost to the firm is represented as R sub DT, which is simply R sub D, the investor's expected return, multiplied by the reciprocal of the tax rate, which is simply 1 minus the tax rate. This tax benefit is a subtle but important detail when computing weighted average cost of capital. Be very careful not to skip over it. This tax benefit is one reason companies often favor debt financing in their capital structure over the use of equity financing, which is not tax deductible. This concludes the current segment of our weekly lecture series. As always, reach out if you have any questions about the course content.